Morning, Ryan Hanks here, founder and CEO of Madison Capital Group. Here in our new office headquarters here in Charlotte. We moved in here about 2 months ago. This was a building that we bought 2 years ago, right next to a multifamily development project that we're building in the lower south end part of Charlotte. We've got about 95 people here in this office with us, so it's been a great new space for us. Our team's been excited. We moved from the South Park area where we had been for about 10 years, maybe longer. And we had grown so much over that time frame that we were really taking up 4 different spaces, I think at the peak, scattered throughout the building. So now we're all under one roof and excited to be here. And we'll give kind of a tour of the property and a separate video as I kind of give a little bit more of a State of the Union market update and so on and so forth. So be on the lookout for that in the next couple weeks. But anyway, good to be with you. Happy holidays to everyone. This is kind of an annual year-end catch-up on all things Madison, kind of what we've been doing, what we're thinking about for next year, and so on. So, end of the year on a very positive note. Obviously, the last couple years, for anyone that pays attention to the capital markets, it has not been easy. That's no secret. Really. I think everyone was very negative until the election, and then we thought there was a whiff of some positivity. And then, I think a combination of tariffs and some geopolitical things have probably stalled economic growth, at least the perception of economic growth, which has, hurt interest rates, has probably hurt capital markets liquidity more than everyone would have liked with Trump in office. But I think 2026, from where I sit, it seems to be the first year where, with a new Fed chair, now you're on the second half of Trump's term. I would expect to see some real kind of rocket fuel put on the economy, which will also, put some fuel on the commercial real estate market, the residential market. I firmly believe that, Trump is not going to go out without a bang on the economy side. I would not bet against the stock market going down. I would bet heavily that rates go down and values go up and so on and so forth. So we're very optimistic as we head into 26. You started to see some real bright spots at the second half of 25 for the first time in a while. Positive rent growth across our storage portfolio, rent growth again in our multifamily portfolio. Haven't seen a lot of costs come down, but we're now seeing positive NOI and rent growth, and you're seeing more transactional activity from institutions, which really drives the market, the sales market, for the industries that we're in, because the deals are so big. Yes, we sell things at 1031 and private buyers from time to time, but most groups of Madison size, we're traditionally selling to REITs, institutions, and alike. So, again, a lot of positive kind of tailwinds heading into 26 across all of our industries, starting with kind of multifamily. We're finally getting pretty much all the jobs on the sites that we've owned the last couple of years out of the ground now. Palm Coast is the latest and greatest to break ground. We started St. Augustine not long ago. We're about to start a build-for-rent deal in Charlotte that some of you may be invested in. We're very excited about that. We've got about 5 or 6 build-for-rent deals in our pipeline right now in Charlotte, Nashville, Hilton Head. We've got 2 others, Tennessee, Georgia, right behind that. That'll start the first half of this year, Charleston, South Carolina. So we're very excited about growing that business, effectively rental housing that's more horizontal in nature, not vertical like our traditional multifamily deals. So we're excited about the multifamily market. I'm reminded of where I started in my career, which was in multifamily. At a young age, I was fortunate to be very active in the business, and I would put my track record against anyone in the multifamily space in the entire country. I've been involved at this point now with probably just shy of 30,000 apartment units that I've bought and built or brokered, all between DC to Miami, west to Texas. So I've played in that kind of oddly shaped triangle my whole career, know every market backwards and forwards. If you look at Florida alone, I've done, I think now, 15,000. So over half of those units have been in the state of Florida, in every market, Panhandle to Naples, again to Miami and up to Jacksonville. Very, very bullish on Florida. For those that don't know, I recently became a Florida resident like everyone else. So I'm splitting my time between Jupiter, Florida and Charlotte, North Carolina. And we'll continue to get on that path. But, very bullish on what's happening in Florida. I had the pleasure of playing golf recently with Ron DeSantis. He's become a friend. And in fact, called me this morning. Really somebody we're going to stay close to in his final year of term. But even after that, as I think could be some things that we work on together in the private sector. But yeah, just very bullish on the state. I think that they're doing a lot of things right. I think the combination of affordability for the middle markets and job opportunities are very attractive. So multifamily, I'm very bullish. I've seen a lot of cycles come and go. This one's been a little bit different because you've just had so many geopolitical things going on, interest rates rising at such a rapid pace like we've never seen before. Keep in mind, you're coming off a pandemic, so things have just been hard. I mean, everything ever since the pandemic, things have been hard. We can go into a million reasons why, but hiring people, capital markets, banking, the list goes on and on. Insurance costs. So there's just been an anomaly of things happening that I've certainly never seen in my career, and I think most people that have been active. We have an investor who was active in real estate in Miami and New York City since the 60s, and he's never seen anything like that what we've seen since 2000, 2001. So interesting times. I think 2026 is going to be some more normalization, which I think everyone welcomes. Normal transaction flows, kind of a normal interest rate environment, not these massive lows and massive highs. And you can kind of budget around that. You can build a business around that. And so I hope that's the case in 2026. But in multifamily, we're sticking to our guns. We have been acquiring properties. Keep in mind, of that 30-some thousand units, I bet half of that has been acquisitions. So we've got a long history of acquiring properties and making a lot of money doing that, buying low and selling high. I think right now it's a mixed market where some markets it's better to buy than build. And some markets, it's still just better to build. The cap rates and values are just too low to get in those markets. So, multifamily will continue to drive opportunities there. Hopefully, create some top line growth within the holding company. Storage, we are looking at an exit. We are looking at a recap or an exit in our storage business. Confidentially, things I can't get into, but we are talking about a large merger or a recapitalization of that business, or which may lead to just an outright sale. We still like storage very much, but we've created such a large platform there that we think has value. So there's probably a strategic merger or recap that happens that would create some liquidity, give us more firepower. Again, we're still bullish on the business. We still want to see Ghost Store grow and flourish. But I think there's some exciting things happening there that we can kind of finally monetize our platform around. I think, we still have got about 10 or 12 development deals going. We're chasing a couple acquisitions, raising capital institutionally, privately. So it just seems like now's the right time to try to do something bigger there across the platform. So we've also, throughout this last year, we've morphed our Bluegate business fully under GSI. So GSI was providing all the back office and management support anyway on the operational side. And we feel like by rolling up, the boat and RV storage and marinas under Bluegate, that then now will also give us probably more, investable capital and probably drive more some of our institutional relationships and private relationships into those verticals as well. We still see a lot of opportunity in that marina and boat and RV storage space. They're highly fragmented on the acquisition side. We're buying from mom and pops. It's kind of what storage was 20 years ago. So our team's got a really good pipeline of opportunities there that we're capitalizing as either kind of 1031 syndications or, like I said, we've got an institutional capital partner, Gem Realty out of Chicago. We've got a 50 million allocation today. They have the ability to increase that to 250 million. Just in that Bluegate space alone. So we want to put that capital to work, and the team's doing a good job of finding opportunities there. One key hire that we had this year was on the commercial side. So Ken Carpenter brought in a guy named Matt McCoy Matt was a senior principal at East Still Securities. Before that, he was a principal on a huge net lease company, multi-billion-dollar net lease company that did development and acquisitions in the triple net lease space and build-to-suit space. Matt's going to lead our commercial team. We think that's got a ton of potential. We have been kind of doing that through our convenience store funds and through some DSTs and 1031 syndications. We've been kind of modestly growing that portfolio and quietly probably built a 100 asset portfolio of net lease properties over the last 7 years. We think with some focus and attention and leadership, we can grow that into a much larger business. We've got a couple clients that are already kind of built in. If you think about Lynx and Fresh Stop, and that plays into the commercial side and having their arm be the development acquisition arm. And obviously Benco Commercial is our construction arm to service those deals. But I think Matt, is working on several other clients, both banks and QSRs and things like that we can be a development partner for. So I'm excited to see the potential of that this year. I mean, net lease is a multi-trillion-dollar business. If you look at the REITs and the activity that happens in that world between 1031s and public money, it's a huge business. It's not a ton of capital. You can scale a business quickly. So we're hopeful that Matt can do that for us as well. So like I said, as we head into 26, our three main food groups now, multifamily storage / boat and RV storage / marina, and then commercial, really are poised for some really good opportunities. I think the fact that we've kept the platform intact through the hard times is going to prove to be very valuable to us as we head into this new chapter of Madison's life and this post-COVID mess that everyone's been navigating for the last 4 or 5 years. Outside of that, Lynx and Fresh Stop are doing great. We'll finish the year. I should say by the end of Q1, we'll have about 40 Lynx out there. We've got a couple under construction now. We're capitalizing a 3-property portfolio in Florida, Orlando, Palm Beach, and Bonita Springs, Naples area. So those 3 should start in Q1. But that'll get us over 40 stores on the Lynx side. Fresh Stop, same thing. We're finishing the year strong on the acquisition side. We should go over the 40 number there as well. Both are really poised to have great years. We're really ramping up the development efforts there. Again, we've kind of made some personnel changes on that side to just beef up the staff so that we can be more active. Obviously, growth is the key to making those deals successful or those platforms successful, and how we increase EBITDA will obviously increase our valuation. So we've got to add more stores. We need to scale the businesses both moderately, but we need to make it happen. And how we're able to do that is through development and acquisition activity. So we're very excited about what's going on in that space. We've continued to see a lot of private equity enter that space. I have no concerns about being able to exit those businesses once we get the scale to the right level, or certainly recap those businesses. But the EBITDA has got to be there. We've got to get cranking on building these things and not have them focus solely on tax strategies and things like that. So that'll be a great thing, I think, in the years to come. So again, very excited about everything we're doing. I think one of the key things, takeaways for me over the last year, and as I think about where we are today, I would say the opportunity to upgrade talent is as good as I've ever seen it. There's, most companies our size are letting people go left and right. People are scaling back. They can't afford to keep up. They're not doing enough deals. I think the fact that we've got diversity across so many verticals has allowed us to really be as successful as we are. I think if we were a one-trick pony, we'd be struggling a lot more, but we're really in talent acquisition mode. There's a lot of good people out there that have been let go. It's been extremely hard to hire good, competent people over the last, again, post-pandemic. You're starting to see that change. You're starting to see some opportunities, and I want to take full advantage and really upgrade some B and C players with A players. And we need less people, but better people. That's kind of the idea. So I'm really in team management right now as I think about how do we set ourselves up for this next run, because there is going to be another run. I want to be teed up. I want to be as efficient as possible. I want to work smarter, not harder. And so I'm very focused on, I would call, talent management right now, and really spending some time in the market, picking up some good people that are going to really help Ken and I grow not only the MCJ's platform, but also our links and fresh top verticals as well. So I appreciate everyone's time. There'll be a deck to follow this video, that'll kind of touch on some of the other things. Rialta continues to do very well. You'll see some write-up about that. Again, same thing. Talent out there is available as that industry consolidates. I do think that's a business we do exit this year, so we will create some liquidity through Rialta. We brought on a guy, Scott Smith, extremely well known in the industry, to kind of be the president, lead us through kind of the sale process, if you will. We've engaged a bank out of Philadelphia, Gladstone. So we're in conversations with two groups right now about a merger and or sale of that business. We also want to be careful because that business does feed a lot of business to Madison. We raise a lot of capital through the broker dealer. We've got some allegiance there with a lot of advisors that sit at Rialta that are probably responsible for 200 million, at least 150, if not 200 million of equity a year into Madison's company. So we want to be mindful of how we keep those relationships, but create liquidity. So that's kind of what I'm working on. But you'll see that in the write-up as well. But we're very happy to have Scott on board and kind of leading us through this transition as we think about a way to create some liquidity there. But anyway, as always, please reach out with questions. You'll see a lot more activity coming from us in terms of external marketing. We're actually having our first Investor Day conference on January 29th. A good friend of mine, Peter Linneman, which is one of the top real estate economists, is going to come into Quail Hollow and speak with us for 30, 45 minutes. We have family offices, advisors, ultra high net worth investors, etc. that are going to be attending, as well as some of our board members, etc. So I think it's going to be a great event. That'll be the first of many that we start doing, really just to educate and communicate on really just the strength and size of Madison and get people excited and interested in what we're doing. So happy holidays, happy new year to everyone, and look forward to touching base. Thank you.